Good morning. My name is Karen Roll. I am the Inspector of Banks and Trust Companies within the Bank Supervision Department of the Central Bank of the Bahamas. It is my pleasure to serve as the moderator for this morning's webinar and to welcome you to this lecture series titled The Central Bank's Safety Net System. How do we protect you? This morning's speakers are all members of the Central Bank's Resolution and Crisis Management Unit. This is a newly created unit that falls under the Bank Supervision Department of the Central Bank. I'm sure you all geared up to hear from our speakers on this very important topic. Just before I introduce the speakers, I just want to make an important announcement. We do encourage you to use the chat feature in terms of posting any questions that you may have for our speakers. So in terms of the lineup of speakers this morning, I will just very briefly introduce them to you. This morning we have Ms. Cindy Thompson, who is the Deputy Manager, and she heads the Resolution and Crisis Management Unit. She is joined by members of her team, Charles Greenslade, who is a Senior Analyst within that unit, Anika Cooper, and Raquel Sands, who are both analysts within the Resolution and Crisis Management Unit. So now I turn things over to Cindy, who will move straight into the presentation. I will return at the end to lead off with the Q&A. Over to you, Cindy.
Good morning, everyone, and thank you for joining today the Resolution and Crisis Management Unit as we present the Central Bank Safety Net System. The Central Bank's mission is to foster conducive to economic development and to ensure a stable and sound financial system through the highest standards of integrity and leadership. The bank's functions are carried out under these 5 main departments, with operational support provided by units such as finance, information technology, legal and internal audit, as well as corporate strategy, risk, and governance. The bank's supervision is further spread and separated into units, which includes the Supervision Department, On-Site Examination, Policy, Authorization and Administration, Analytics, and today's focus, Resolution and Crisis Management. This unit is responsible for resolution, which deals with the likelihood of an institution failing, crisis management, which deals with the stabilization of the financial system during stressful events, and the management of the deposit insurance daily operation. The central bank has a number of strategic goals, one of which is the safety and soundness of the financial system. Pursuing these strategies to ensure compliance with international standards, to strengthen the bank and trust sector, to mitigate risk through crisis management preparedness arrangements. This brings us to the safety net system, which includes a number of internal and external stakeholders. The functions of the safety net system are connected and must be coordinated in order for it to be effective. This framework includes the lender of last resort, represented by the central bank, the oversight, which is provided by the supervisory financial institutions performed by bank supervision. They would also advise resolution when the SFI is no longer viable. Resolution then provides the best resolution option for the failing institution. Deposit Insurance Corporation then provides coverage to its members, and the Ministry of Finance provides backup funding when needed. The Central Bank's Bank Supervision Department, also known as BSD, ensures institutions follow industry's best practices through licensing, regulation, and supervision of the SFIs operating in the Bahamas. The on-site examination unit conducts periodic on-site exams, and then the central bank is also responsible for of the Deposit Insurance Corporation, also known as the DIC, as well as the fund. This includes the responsibility of its daily operations, and the DIC would receive periodic reports from supervision in relation to its members and industry trends. Resolution and Crisis Management, as mentioned, is a new unit that identifies options to resolve institutions in distress. It also depends on supervisory reports and updates on or from other units in the bank supervision department. And it ensures that the SFIs are viable. In collaboration with the DIC, it appoints a liquidator and works in conjunction with them to enact a deposit payout after a failure. The DIC is accountable to the Minister of Finance for its actions and decisions made, inclusive of providing an annual report. The Minister of Finance is allowed to levy special contributions to its members if there is a shortfall in deposit insurance funding. To elaborate more on deposit insurance, I will now welcome my colleague Charles.
Good morning, everyone. I would like to just provide you with a brief overview of the Bahamian Deposit Insurance System, which is designed to provide protection to small Bahamian dollar depositors and foster confidence in the Bahamian financial system. Firstly, I would like you to take a note of these four major events in the deposit insurance system. In 1997, the banking license of Gulf Union Bank was suspended due to its liquidity issues and a failure to satisfy the statutory requirements of the central bank. Therefore, the bank was later placed into liquidation. In 1999, the DIC was established to administer the Deposit Insurance Fund in an effort to protect the financial system from the effect of this bank's failure. Thus, insurance coverage was made retrospectively to depositors of Gulf Union, protecting almost 90% of the deposits. In 2020, the DIC legislation was amended to strengthen and expand the insurance mechanism and governance arrangements. In particular, membership was extended to credit unions. In 2024, the DIC's premium rate was increased to 1/10 of 1%, doubling from the previous rate of 1/20 of 1%, to strengthen the DIC's funding capacity. So just to be clear, the DIC's objective is to provide deposit insurance protection and support for the Bahamian dollar depositors, and thereby contribute to the stability of the domestic financial sector by minimizing risk of loss to the depositors. And this is achieved through strengthening public confidence in the financial system, managing the deposit insurance fund, facilitating payouts to depositors, and supporting resolution functions and decision making. Now we can talk about what you would all really like to know, and that's what is covered. The DIC insures only Bahamian dollar deposits placed within members' institutions up to a maximum of $50,000. And these deposits can be spread across checking accounts, savings accounts, demand and time accounts, as well as other accounts payable for which certificate, receipt, check, money order, draft, or other payment instrument has been issued by the member institutions and for which the member is primarily liable. But there's more. The DIC's insurance coverage is also based on rights and capacity. Therefore, a person can have the maximum coverage of $50,000 within each of these five categories. The first category is an individual and nominee accounts. And an individual account is an account that maintained by a person in his own name on his own behalf. While a nominee account is an account where an individual or entity holds an account on behalf of the actual owner. Then the second category is trust and client assets accounts. These are accounts held in trust on behalf of clients. The third category is personal representative accounts, which are accounts of descendant held in his name, in his name of the executor or administrator of his estate. The fourth category are joint accounts, an account in which more than one person has interest. And it is notable that for joint accounts, each account holder is assumed to have equal share in the account, unless the records show otherwise. And finally, we have company accounts. These accounts are accounts of companies that are incorporated or registered under the Companies Act. Here, we have three examples of individual accounts, which I hope will provide you with some insight on how the DIC calculates payouts. It is also important to note that if an account is attached to a credit facility that has a payment or installment amount that is due or past due with a member institution, or has deposits pledged as collateral, then the total deposit balance would be reduced by this amount in calculating the amount insured. So if we look at the first example, which is the client's 2303, which has $15,000 in their demand deposit account, $14,500 in their fixed account, and their accrued interest balance is $90, which brings the total value of the deposit amount to $29,590. However, this individual also has a credit exposure of $95,000. So you may know that the person also has a loan that is over 1 to 30 days past due of $440. So their total insured amount would then be $29,150 because the DIC would deduct the amount that is past due. In the second example of the individual, the client with 5896, which has $15,000 in their demand account, $20,000 in their savings account, $5 for their accrued interest balance, which bring their total deposit amount to $35,500. And this person would have $150,000 of credit exposure. So you should know that this person would now have a non-performing balance. And the DIC's goal is to not punish depositors who have loans in good standing. So prior to the amendment in 2020, the DIC would have deducted the entire loan balance, but we only deduct now for accounts that has loans that are non-performing. Thus, this person would be able to get none of their insured deposits. And in my final example, 1125, this person has $70,000 in their savings account and $2 in their accrued interest. Their total exposure is $20,000, but they have a deposits of pledge as collateral of $5,000, which will bring their total insurable amount to $70,000, $70,002, but the maximum coverage will only be $50,000. In regards to funding, the fund was established by an initial contribution of $1 million, of which $500,000 was required to be paid by the central bank and the balance by member institutions. Since then, the fund has grown by an average rate of 10% through the continued investment of annual premium receipts in Bahamas registered stock and the reinvestment of the interest income received from these stocks. You may also note that the COVID-19 pandemic had no effect on the fund's growth, which can be seen in the graph to your left. The deposit insurance fund reached approximately $89.2 million as of December 2023, and was equivalent to 3.3% of insured deposits. The target size of the fund is currently 4.67% of insured Bahamian dollar deposits, and the DIC aims to reach this target by 2026. In dollar value, the target size of the fund would therefore be $125.3 million, and once this target has been met, the DIC intends to gain an additional buffer of 1%, which would bring the fund to $152.2 million. If you would like to know more about the BS, www.dic.bs, or any one of our social media platforms, which are Facebook at Deposit Insurance Corporation, or Instagram or X at DIC Bahamas. To tell you a little about the resolution, I would invite my colleague, Anika Cooper.
Thank you, Charles. As my colleague would have mentioned, I will be talking to you today about the Resolution Authority and its role in the safety net system. So Central Bank is empowered as the sole resolution authority established under the Central Bank Act 2020. The main aim in establishing this authority is to prepare resolution plans in consultation with the SFIs. to identify options for the use of its resolution power and tools. The key attributes of effective resolution regimes sets out the objective of resolution for financial institutions. And that is to make feasible the resolutions of those institutions without severe systemic disruption and without exposing taxpayers to loss or while protecting the vital economic functions. To have a more granular view of the main objectives of the resolution framework, the intent of this framework is to, 1, maintain financial stability, 2, to protect and enhance public confidence in the stability of the banking system in the Bahamas. 3rd, it aims to protect depositors by ensuring prompt payouts of deposits of a bank in liquidation. It also aims to minimize the cost of resolution and avoid unnecessary destruction of value. And lastly, the objective is to protect public funds. Recovery and resolution planning. Now, as the resolution authority, when we look at recovery and resolution planning, the key elements needed when resolving a failing institution or a failed financial institution. Firstly, we would need to conduct a crisis diagnostics. And in order for this crisis diagnostics to take place, the financial institutions are required to submit their recovery plans for review by the supervisory team in the Domestic Financial Institutions Unit, otherwise known as DFIU, and the International Firms Unit, otherwise known as IFU. And these recovery plans in review require that the financial institutions effectively prepare for the worst crisis situations, such as liquidity or capital crisis, detailing steps they would need to take for remediation in the event of financial distress. And secondly, we have our resolution strategies, which involves resolvability assessments and resolution plans, which are both performed by the resolution team. So in the case of resolvability assessments, this is done to evaluate the feasibility of our resolution strategies and the likely impact of failure on our financial system. And further, in regards to resolution plans, these are prepared to make resolution possible with minimal disruptions. This also entails facilitating the effective use of resolution powers by having an approved strategy and an operational plan for implementation. The effectiveness of our framework is dependent on the tools and options that we have available as the resolution authority. And the resolution toolkit lays out the options available to us as the resolution authority when resolving a failing institution. And these options are liquidation, closure, transfer, sale, and recapitalization. And just to go into more detail about the options, the first option, we have liquidation, which involves the closure of a financial institution and a payout of insured deposits, followed by the liquidation of the bank. And these steps to conduct this option, step 1 would be to appoint a liquidator of the financial institution who would be named by the statutory administrator. And essentially what a statutory administrator is, legally, it's a legally appointed manager of the failed financial institution's book of business. Second, eligible deposit balances would then be calculated, and the DIC would confirm the amount to be paid to each depositor, and the last payments would then be made to depositors per depositor per deposit category. The next option that we have available, we have closure, which entails the closure of the financial institution and transfer of insured deposits to another bank or a bridge bank. And essentially what a bridge bank is, it's a temporary bank that is set up by regulators with resolution authority, that being the central bank, to operate as a failed or insolvent bank, to operate the failed or insolvent bank. And these steps include step number 1, the appointment of an administrator to the financial institution. Step 2, eligible deposit balances would be calculated, as in the first option, liquidation, would be calculated, and the DIC would confirm the amount to be paid to each depositor. Step 3, the receiving financial institution would purchase assets from the failed financial institution, and deposit accounts would be transferred from the failed financial institution. And last step, the failed financial institution would then be wound up. Then we have the option to transfer some of or all of the failed financial institution's assets, liabilities, and business functions to another existing financial institution or a bridge bank. And these steps include step number 1, appointment of an administrator to the financial institution. Step number 2, we would then have an assessment. An assessment would be conducted on the business that is to be transferred to either an existing bank willing to acquire this business or to a bridge bank. Step number 3, the failed financial institution would then be wound up. And lastly, step number 4, all the non-performing loans would be retained in the failed financial institution or transferred to an asset management company established by the Ministry of Finance. The next option that we have the sale option, and that would be sale of the financial institution to another financial institution. And this would involve placing the financial institution into administration and selling a majority shareholding position to an acquiring financial institution. And lastly, we have recapitalization of the bank through the use of public funds. And this is normally done as a last resort option. This would only be used where the other options have been assessed and are considered to be impractical. And the first step in this option would be the appointment of an administrator to the financial institution and assessing the worst case capital position of the financial institution. Then the second step would be recapitalization would be implemented by the issuance of shares to the government sufficient to achieve the target capital ratio. And now I will hand things off to Cindy, who will conduct and lead the simulation.
So good morning again, everyone. And so we have just went through what the DIC is, what resolution is. And so we thought it would be helpful to see all of the safety net partners working together. And this is the Bank 50 simulation. This exercise aims to just be an example of how the safety net units are interconnected. So all of the information that's preceding these slides are fictitious and just serves the purpose to present the simulation. So about Bank 50. Bank 50 is a small domestic bank that has been in operation for the last 12 years. The majority of the institution's business focuses on personal lending and small business lending, and it isn't concentrated in any specific industry. The bank has a healthy level of deposits and it offers interest on its $dollar accounts, which is unknown for most banks. It has been a member of the DIC since its inception and has always paid its annual contributions on time. In 2022, Bank 50 had 250 million $dollar deposits, 187.5 million in loans, and a capital adequacy ratio of 24%.
Capital adequacy ratio, or CAR, is a ratio of the bank's capital to its risk-weighted assets. It ensures that banks have enough funds available to handle a reasonable amount of losses and prevent insolvency. The statutory requirement for CAR is 17% for domestic financial institutions, commercial banks.
In 2023, Bank 50 changes their investment strategy due to new management. They shifted 50% of their growing deposits from their long-term government bonds to a high-yield agriculture security, hoping to gain quick returns in the industry due to buzz on new emerging technologies in that industry. The bank, however, failed to do their due diligence and proper research, and after purchasing the securities, they suffered huge losses as it was announced that the agriculture project owner backed out. The loss impacted Bank 50's ability to meet their depositor withdrawal demands. And by mid-year, the bank's quarterly financials showed a notable dip in liquid assets, triggering a supervisory response. The Domestic Financial Institution Unit, DFIU, and Bank Supervision Department contacts Bank 50 to inquire on the state of its monthly financials and its plans to repair them. Bank 50 advises DFIU supervisor that the bank plans to sell its assets to cover its current liquidity issues.
Liquidity refers to how easily and rapidly an asset can be converted into.
Bank 50 tries to sell some of its assets, but it suffers additional losses as investment market is not favorable. The bank's loan book is currently at a standstill due to all the loans associated with the new agriculture market being subjected to additional requirements or just flat out denied. As at the end of the first quarter, losses on the sale of assets have impacted the bank's CAR, which is now at 17% and is projected to be below the regulatory standards or threshold by the end of the year. The bank is in further discussions with the DFIU supervisor, advising them that they will enact their recovery plan in an attempt to inject additional capital into the bank within the next 90 days. Through the activation of their recovery plan, Bank 50 manages to raise some capital, but the firm still suffers additional losses and the loan book worsens. Non-performing loans escalate and customer deposit demands rise due to a strong economic downturn. This downturn is based on the fact that the industry expected a big boom, the new agriculture project in terms of jobs, in terms of new developments, and therefore the economy is now suffering because of it. The head of bank supervision advises the Resolution and Crisis Management Unit that the bank is most likely to fail and we should consider resolution options. RCMU begins to determine the least cost method of resolving Bank 50 based on the resolution plan previously prepared for the institution, now that the bank has breached its CAR and is insolvent.
Its insolvent is being unable to pay the debt.
As at the end of 2023, the bank's CAR is now 15%. Bank 50 has 130 million in $dollar deposits, which 72% is deemed to be insured by the DIC. This is $100 million in deposits.
This is Bank 50's resolution plan. The resolution team reviews and deliberates the options in the toolkit. We note that Bank 50 is not considered a DSIB, domestic systemically important bank, representing only 2% of the banking industry. We also note that its portfolio of loans is not concentrated in any one industry. So failure will not impact the financial system. The Resolution and Crisis Management Unit advises through discussions with Bank Supervision, the Deposit Insurance Corporation, the Governor of the Central Bank, the Inspector of Banks and Trusts, and the Ministry of Finance of the impeding failure and the least costly approach.
The resolution team considers first a closure with the attempt to transfer the insured deposits and the performing loans to another viable bank. During the negotiation process, it was deemed that this would become more costly to the Deposit Insurance Corporation if they were to try and complete the transfer. Therefore, by the end of the first quarter, RCMU advised the safety net partners that the best resolution option for Bank 50 is liquidation. This process includes the closure of the bank, payout of insured deposits, and the liquidation of the bank.
Once the DIC is notified of Bank 50's closure, the DIC will begin to collect depositor data in order to obtain a true insured level of insured deposits to be able to advise the other safety net partners. In this scenario, the true level of insured deposits is 82 million. After the netting effect of insured deposits and outstanding loans, the DIC confirms the deposit payout of 75 million. The Deposit Insurance Fund currently is at $99 million at the end of December 2023. One of the main functions of the DIC is to maintain the level of the fund at a specific level, retaining at least 25% for possible contagion effects.
Contagion is a spread of crisis from one market or region to another. In this case, the failure of banks triggering another SFI to fail.
The DIC then advises the ministry that it can cover 64 million in the payout and requests that the government assists with the remaining 11 million. During the closing process of Bank 50, the DIC will communicate the failure, advising the public that the bank has failed and that the insured deposits will be paid. A statutory administrator is appointed to handle the liquidation proceedings. The DIC confirms amounts to be paid to the depositor with the assistance of a bank appointed paying agent.
A paying agent is an intermediary who distributes funds on behalf of the issuer.
The payout process of insured deposit commences within 7 to 10 days of the closure. Uninsured deposits will be reimbursed through the liquidation process.
That brings us to the end of our simulation. And so there's a few things that we would want to remind everyone based on the session, that the safety net system and its functions require consistent and clear communication and coordination with all partners. Weakness in any one element can compromise financial soundness. For example, a small distress in one institution can affect other financial institutions. Ineffective resolution strategies can increase the cost to the Deposit Insurance Fund. Delayed payouts can negatively impact consumer confidence in the entire system. So just a reminder as to the main safety net partners within the central bank, we have Bank Supervision, who is the first point of contact with the SFIs. They monitor and examine and advise the FSIs to promote financial soundness in the banking system. The Resolution and Crisis Management Unit resolves financial institutions through appropriate resolution tools, minimizing the cost for an orderly and timely resolution. And the Deposit Insurance Corporation ensures that the BDOL deposits for the member institutions are managed and the fund is also managed. We support the resolution functions and we also make decisions. The Ministry of Finance provides backup funding, support to the safety net system in the event that the Deposit Insurance Fund is needing the additional assistance. With that, we come to the end of our session. And if there are any additional or further questions.
Thank you, Cindy, Charles, Anika, and Raquel for a very informative session. I think there were a couple of questions in the chat tool. I attempted to answer a few of them. I see one that was just posted. Were there many bank failures during the pandemic that prompted the passing of this Resolution Act? I could address that. During the pandemic, there were no bank failures. In fact, the team spoke to the one bank failure or the one experience that the Bahamas has had with a bank failure, which was Gulf Union, back in 97? So during the pandemic, while the legislation may have been passed in 2020, the powers of the central bank as the resolution authority certainly is something that the bank has been addressing, and really and truly the provisions that were placed in the Central Bank Act, as well as in Banks and Trust Companies Regulation Act, was to clarify the bank's powers, because some of the powers were shared between the Central Bank Act and the Deposit Insurance, the Protection of Depositors Act. And so the act simply clarified the bank's authority as the resolution authority. And this is in line with international practices. And so, so it was not prompted by any failures, but it certainly is positioning the bank and strengthening the bank powers to deal with any potential failures of a bank or a credit union. So thank you for that question.
In addition, there was a follow-up question on how does the DIC fund grow? The fund levies premiums to its member institutions, and that premium is 1/10 of 1% that they charge every year. And it is then invested into mostly government registered stocks.
Also, Cindy, the annual report, the 2023 annual report, there was a question as to where that could be sourced.
Yes, the 2023 annual report is currently in its final stages. It can be sourced on the website once it's finalized.
Okay, thank you. So there's a question about what is the process of liquidation for credit unions? And so very similar to any other financial institutions, there would have to be the appointment of liquidator. In the case of a couple of credit unions, small credit unions that are currently undergoing liquidation process, the Credit Union League has stepped in as the official liquidator. And, the process is really determining the available assets of the credit union, as well as the deposit, the member deposit, to determine, what liabilities exist, or creditors, I should say, exist to be repaid out of the funds owned by the credit union. And so certain notices are sent to advise the public who may have funds with the credit union, so that they could, present any claims, and any other creditors that they could present their claims to be repaid by the liquidators. And so it's very similar to the process that's being done for a bank. And as I mentioned, in the instance that we've seen only a couple very, very small credit unions thus far that have actually went through the liquidation process, that since the credit union came over under the supervisory remit of the central bank in 2015. And that process really and truly has been handled by the league.
So the next question is, what is the latest available total of insured deposits in the system? and that is taking into consideration loans past due or other obligations. So the last published information in relation to the total amount of insured deposits is about 2.7 million. We will have to confirm the additional caveats in terms of past due loans and have that amount updated.
So, the other question is the DIC providing the payout funds to the league for payout to credit union depositors? If you are referring to, credit unions that are in liquidation, the payout to depositors would, be carried out based on the assets of the credit union or once the liquidators are able to source assets. Meaning, if it's loans and having those loans repaid or any debt that's owed to the credit union is repaid, funds coming into the credit union, then those are used also to pay out depositors. So if that was the question as it relates to liquidation, though the depositors would be paid out first out of the assets owned by the credit union and not the DIC. And if you were referring to if a credit union fails and DIC payout process is invoked, the DIC certainly would provide the funds in the first instance to pay out the depositors of the credit union. And the DIC, of course, will be reimbursed as a part of the liquidation process. Okay, there was another question here. Thank you for the recent strategic contributions for continued greater community engagement and education being executed by the Central Bank Leadership. So thank you very much for that compliment. And the Central Bank, of course, is very keen to have these types of sessions and forums whereby we inform the public of the work that we're doing to give better insight into our role as the regulator and some of the strategic initiatives that seek to strengthen the financial system. And so just trying to give an insight in so that the public could be better aware and better informed. So thank you very much for that. Okay, I don't see any other questions at this time. So I will then close out the Q&A session and thank Cindy and her team for a very informative presentation. I do believe that the slide deck could be made available. And as the presentation has presented in terms of how you can keep in contact with us, please use those forums if you have any other questions that you wish to raise with the Central Bank on this particular topic. So ladies and gentlemen, thank you very much.
Sorry, there's
go ahead,
actually
go ahead.
another, there's
Oh, you do?
another
You see
question
another
that just
question?
came through. Yes. So where would the DIC stand in order of priority in being reimbursed through the liquidation process? So during the liquidation process, the DIC first ensures that the insured depositors are paid out. And we would have to perform due diligence on the exact amount that the depositor who is about to receive their payout should receive based on, like has mentioned earlier in the simulation. And Charles's examples, you would have to determine exactly what is past due, how many accounts they're attached to finalize the total insured payout. During the liquidation process, which is performed not necessarily by the DIC, but by the statutory administrator, there are a number of other persons who are uninsured that would be paid at that time. So it's including the uninsured depositors. If we did get a loan or additional funding from the Ministry of Finance, they would also be paid during the liquidation process. And this process normally takes a few months to a few years to resolve itself. So the DIC's focus will always be the insured depositors, and then the statutory administrator will do the rest of the process in terms of finding out. So thank you for that question.
Okay, so if there are no other questions, once again, thank you, Cindy, Charles, Anika, and Raquel for a very informative session. And thank you, ladies and gentlemen, for taking time out of your schedule today and joining us in this webinar. And I do encourage you to look forward to continuing to be a part of our future webinars on our future lecture series. So keep an eye out for upcoming events. Thank you, take care, and have a wonderful day.